Mohnish, thank you so much as always for being here. We're incredibly grateful. And let's get started if you're ready.
Well, Arvind, it's a pleasure to be here with you. I always look forward to this particular session every year. And actually, the best way to learn is to teach. And I always come away slightly wiser at the end, not so much because of what I said, but because of what some of the interactions and such. So I'm very grateful. And so I'll go through some prepared remarks. I mean, they're not really prepared, but they're, let's say, a monologue. And I have a few slides. And then I think we can open up for questions, which is the fun part for me. And we can focus on what I talked about, or we can focus on pretty much anything under the sun, maybe other than specific portfolio positions and such. And we can take it from there. Is that good? Oh yeah, here it is. Okay, all right. So in the early 2000s, this book came out by Maggie Maher, and actually Buffett had recommended this book. It's a great book to read. And basically Maggie pointed out that even though we have these, like if you look at the S&P over a 100-year period, 9% a year, that's not the full truth, if you will. And there's more to that than just that 9%. And so this is a chart of the Dow from 1896 till now. So it's covering about 124 years. And you can see that there have been very long periods where end-to-end the result has been zero for investors. Like for example, a famous one is after the crash of 29, it took a good quarter century to get back to the same levels. And more recently, if you look at the period from 65 to 82, the Dow was like, I think 870 or 865 or so at that time in 65. And that's approximately where it ended in 81, 82. So 17-year period when the US economy grew quite a bit, but the Dow was flat. And then 82 to 99, which is also probably before the time of most of the people attending, the Dow was turbocharged. It went from less than 1,000 to more than 12,000. And then more recently, from 99 to 2011 was flat. And then since 2011, we've been on the rise. So, and then, if I just, I'll show you a few more charts like this, but this particular one has some symmetry. So the symmetry is that we had a 17-year period, 65 to 82, where the Dow was flat, and we had another exact 17-year period when the Dow, did incredible things. And the reason we get these periods, and especially I think 17 years is an important number. In general, human memory does not go past 17 years. And the reason we see these kind of long periods of flat markets and then, similar periods of, very euphoric rises in prices, if you will, or just rises in prices, is usually, like, for example, in 1965, stocks were quite overheated. Very high PE ratios, high multiples. And in 81, 82, they were extremely undervalued. And one could argue whether it's undervalued because at that time in 81 or so, treasuries were yielding 18%. And so in the 81, 82 timeframe, you could have bought a lot of blue chips at single-digit multiples. Coke and McDonald's and all kinds of great businesses were available very, very cheap. And then when you got to 99, 2000, those same businesses were priced for perfection. So for example, in the year 2000, Microsoft became, for some time, the most valued company on the planet. Cisco was right up there. Both these companies were about 600 billion or so in value. And Microsoft, I think, was making less than 10 billion. And such. So it was at a pretty, I think it was at a 70 plus trailing earnings multiple. And so these charts are very relevant to me because I always have great timing in life. And I started my fund in 1999. And what a beautiful time to start a fund. I actually knew pretty soon after I started that I was going to be, I assumed at that time that there was poetry and symmetry, and history did not just rhyme, but history repeats itself. So I just assumed that till 2016, we were going to be flat. I assumed we were going to be flat on the Dow till 2016, and I assumed we were going to be flat on the Dow, on the S&P till 2016 or so. And the NASDAQ, I didn't even know when that would come back because that had crashed and burned from 5,000 down to 1,000. So I thought that was just done for a very long time. So I started my journey as an investor in 94. That was the first time I heard about Warren Buffett, and it opened up a whole big world for me. And 1994 was one of the years of maximized learning and growth for me. It was a completely new area for me, and I was just like a sponge. I was just drinking from a fire hydrant, and it was great. And at that time, life was really good because pretty much anything you did went up. Things. And I was running an IT business. I was kind of around the software business and so on, and so I had some of the investments were tech investments at that time, and in that period, and I was only running my personal money at that time. There was no fund, and in that period, I captured two more than 100 baggers. Unfortunately, there wasn't much of a net worth. And so, for example, one business business in India, I'd put about $10,000 or $12,000, and I cashed out about 1.5 million. And of course, I should not, have any regrets about that. That's pretty good. And then there was another business here in the U.S. So the India business was Satyam Computers, and the one in the U.S., which was a way to, kind of ride the internet wave and so on, upside to the downside. A company called CMGI, actually, I actually visited them in Massachusetts around that period. And that was about 100 bagger, which I captured. And there I actually put in more money. I put in about 100,000. And so the results were pretty good there, about 10 million. So, but then when I was starting the funds in 99 and 2000 and so on, I knew I was going to be facing these huge headwinds. And I knew that that pretty much anything you looked at didn't look. I think all the all the popular stuff was euphoric, but actually the day the NASDAQ peaked in March 2000, March 9th or something, 2000, was the day that Berkshire hit a multi-year low. So basically what was happening is that money was going from Berkshire Hathaway into pets.com. There was that transfer going on. So a lot of stuff actually, which was very basic stuff, was undervalued in 99, 2000. But if you were trying to play any kind of momentum game or, flavor of the day or any of that stuff, you very quickly got your head handed to you. And because then the NASDAQ went from like 5,000 to 1,000 next couple of years, 2-3 years. So I knew that the modus operandi I took on when I started my fund was, I really didn't care about the market much. I knew the market was going to give me a headwind, but I said, how does it matter what these market levels and all that are, or whether it's euphoric or not, if all I do is I focus on buying $1 for 50 cents. And when that dollar gets to 90 cents or more, I sell it. And so that became the cornerstone of how I invested. Is I looked for dollar bills that were trading for 50 cents or less. And then as they got to 90 cents or more, I was unloading them, which was different from the previous 5 years where, like, for example, the company I bought in India, I just took those shares and I actually got physical shares, stuck them in a drawer, and my mental model was to never open that drawer. I wasn't even concerned with, what the multiple was. I knew that they had so much tailwinds in terms of growth that I didn't want to really mess with any calculations. I just said, set it and forget it kind of thing. And the same thing with CMGI, I could not tell kind of what the upper limits of CMGI were. It was kind of very nebulous. But I was buying at a pretty floor price because CMGI was spawning .coms. So, how many .coms they're going to spawn, I have no idea. What valuations are those going to have, no idea. But it all looks like wild and crazy. So we'll just keep the mothership that keeps producing these eggs and see where it goes. And eventually it got to a ridiculous valuation. Thankfully, I was smart enough to sell and move on. But in the last 20 years or 21 years, I took this buy at 50 or less and sell at 90 or more, and that actually works quite well in this environment from 1999 to 2011. So what I'm trying to say is that if I look at my 25-year or 26-year journey, I was using 2 different models for 2 different periods. Okay, and one of the things I forgot, because it had been so long that I'd been doing the buying at 50 and selling at 90, that it completely left my mind that I'm supposed to at some point switch back. Okay, and I never really, I just thought this buy at 50, sell at 90 is kind of the way I go through permanently. And let me just go through some of these slides and then I'll continue with kind of, because the year 2020, most humans want to go from the year 2019 straight to 2021. They want to purge 2020, that they want to behave like 2020 never happened. That's how they would like to go through life. In my case, 2020, I would say, has been probably the second highest year of learning after 94. And so I've had incredible learning and growth this year. I'm very grateful for the learning and growth. Who knows if the pandemic had anything to do with it? Maybe it did, because I got so much time to stare at my navel. And when I contemplate my navel, good things happen. So I had a lot of contemplation of the navel this year. And anyway, so this is the Dow, and you look at the S&P, and it's somewhat similar. It didn't have the exact 17, but recently till 2013, it was completely flat. And then you look at the NASDAQ, and what a beautiful chart. So you look at the NASDAQ, and from 1980 to 2000, 20% a year. Awesome. Great. And then, of course, you can see the head handed to you from 2000 till 2003 or something, when it gets close to 1,000. And then it takes 16 years to get back to the 5,000 level. And then more recently, it's been doing the 21% or so. So the NASDAQ is kind of interesting because it's actually gone through this. And actually, if you think about the NASDAQ, yes, from 1980 to 2000, there was incredible technological innovations in tech and software and hardware and so on. But so was the case from 2000 to 2016. I mean, even till now. I mean, there's been incredible changes. But what happened is that the valuations in 2000 was so high that all the growth and growth in profits and all of that were not enough to get the index back to where it was. So, for example, a good example is Microsoft. I remember in 2000, I just started the fund. There was a guy who was one of the early employees at Microsoft, pretty high up, and he had retired, and he said, he joined my fund. He said, Mohnish, if you're ever in Seattle, I could introduce you to some of my former colleagues and some people who've left, and they may have an interest in your fund and so on. So I told him, hey, I'm going to be in Seattle day after tomorrow. What a coincidence. And so he said, oh, that's great. So we spent a day where he took me to Microsoft headquarters, and I went from one office to the other, and he was he was a great sales guy for me, trying to convince these guys to give me money. And I got a lot of commitments and a lot of investors from Microsoft or former Microsoft people, some current, some former. It was great. But I told them all at that time when we were just talking that I said, look, you guys have, in many cases, 90% of your net worth in Microsoft stock and options, and your livelihood comes from the same place. And I said, I hate to burst your bubble, but this is not going to end well. And they all told me, oh, you don't understand our business. The company's never, the stock just goes up like clockwork, and we get our options and we hang on to them, and life is great. And I told them that was not going to be the case. But none of them actually even wanted to hear the math about the 70 times trailing earnings, or whatever else. And until 2015 or 16, Microsoft was zero returns. And it wasn't just zero returns. It was a very violent ride with a huge drop in the next 2 or 3 years, and then another huge drop during the financial crisis. It would have been very, very hard to hold the stock over that period. And of course, finally, they've kind of digested that, and now we're back on the upswing. And then we get to the Nikkei, which peaked in 1990 and has not yet come back. And so it's been 30 or 31 years of minus 2% a year. So the more fun the party, the more extreme the hangover. And this was a very fun party. This was a party like no other. So at that time, I think in 1990, and this was anecdotal evidence, I looked it up. They said the Imperial Palace in Tokyo was valued more than all the real estate, the entire state of California in terms of real estate. And I actually found that statistic pretty hard to believe, so I actually researched it. And it was absolutely true. Actually, if you looked at the transaction prices of the properties right around the Imperial Palace, and then you extrapolate it to the square footage and acreage of the Imperial Palace, you would get to a valuation that would exceed state of California. And of course, that's a ridiculous valuation. We have beautiful coastline for thousands of miles here in California, and there's some very, 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 very valuable real estate. And so that bubble popped, and we haven't come back yet. And we'll have to see when we come back. And then you look at the Korean Kospi, and this is another one where if you ignore that 2009 to 2011 period, it's pretty similar to Japan. It's basically been about 30 plus years of pretty much nothing. And especially the last few years. And Korea, I mean, if you look at Korea in '89, I mean, the Korean economy as we know it doesn't exist at that time. I mean, it's an incredible miracle growth economy. I mean, Japan was already an advanced civilization. Korea was yet to have its run, and in spite of all that run, the Kospi hasn't moved. And actually, Korea is quite a cheap market. It's a place I'm actually interested and excited to invest in. So anyway, so that's those are the slides I wanted to share, and so if we look at all of this, so in the year 2000, and I told you that I had this this really terrific growth and learning, and when I tell you about what I learned, you're gonna say, what a dummy. Like it took him 26 years to learn this stupid stuff. And some of us are dense, and it takes some time to learn these lessons. So Charlie Munger says we are old too soon and wise too late. And but I still feel it's not too late. I mean, I'm 56. Hopefully there is a good 3 decades of compounding ahead. So that's if I can get 2.5 or 3 decades of compounding, life is great. So one of the things that Munger has mentioned is he said that there's no intellectual way to defend it, but he does not sell businesses he owns when they get above intrinsic value. And he won't buy them above intrinsic value, but he won't sell them if they are, somewhat above intrinsic value, or even reasonably above intrinsic value. I think if it gets to egregiously above intrinsic value, I think he would look at it. But the Berkshire history is that even when they looked at, for example, if you look at Coke, for example, which in the year 2000 was at 40 plus times earnings, and it didn't do anything for a long time because it was quite overvalued. They haven't touched their Coke position in 32 years, and my guess would be they won't touch it for another few decades. So it'll go on for a while. So so when Munger says that he's willing to hold businesses above intrinsic value, that kind of goes against what I'm trying to do with the 50 cents to 90 cents, right? Because the two are different frameworks. And but when I studied that some more, I realized that the key, and this is especially true, I believe, in this period, which is, I mean, so if we look at this period, I wish I had made this change. Ideally, if I'd made this change in thinking about 2 or 3 years ago, that would have been actually, I would have hit the nail on the head perfectly if I'd made this, because by till 2016 or so, the markets really were, they hadn't done a whole lot. And actually the previous approach worked really well in terms of returns and so on. So I was I think I'm probably 2 years or so behind, but in a 26-year history, we can be forgiven for being a couple of years behind on something. So that's okay. So so a few things came together for me this year. Some of you may have looked at a company called NVR, and NVR is a home builder, I think in Virginia, Mid-Atlantic and so on. And they have had religion related to buybacks, which has been very intense. So from 1994 till now, other than for a couple of years in 2008 or 2009 when their business was upside down, they pretty much bought back their stock every year. And over this period, they have spent at least 100% of owner earnings on buybacks, and probably over 100%. They were actually even willing to spend beyond their own earnings on buybacks. And the NVR business itself, if I look at it from 2000, like to the last 20 years, the top line's gone up maybe 3-4 times. It's not a company that has any intellectual property. It's a home builder. So the top line has gone up 3-4 times. They bought back in the last 20 years 56% of their shares outstanding. Over the last 26 years, I haven't looked at it exactly, but it's over 80%. It may be approaching 90% of the shares outstanding have been bought back. But in the last 20 years, the 56% reduction in share count, the stock is up 55 times. So the company delivered a 55x return in the last 20 years against the headwind of overheated index. And that didn't even matter for a company like NVR. And so I looked at NVR, and then I have a friend, Nick Sleep, who's in the UK, and Nick had most of his money, I believe, when he was running his fund, in 3 stocks. It was Amazon, Costco, and Berkshire. And I think it was in 2015 or so, he hung up his boots and returned all the capital he was running. I think he returned probably $3 billion or so to his investors, and basically told them that, in effect, I have 3 stocks. 10 years from now, I'm going to have these 3 stocks. There's no need for you to pay me ridiculous fees. Just go buy these 3 stocks. And of course, his institutional investors freaked out when they got the money back. I got some calls asking, hey, we got this money back. What should we do? I said, he told you what to do, and then they'd say, oh, our mandate doesn't allow us to buy stocks. So then I said, would you like me to set up a vehicle where I buy those 3 stocks for you, and then you can pay me a carry, So, life is kind of funny that way. But anyway, so if you look at Nick also, like Charlie, once he finds these great compounders, and he's got a number of models he's using, he's looking to let them run, and looking to let them run for decades. And actually in Nick's portfolio, it didn't even matter what he owned as long as he owned Amazon. So what I'm saying is that the error rate, he didn't have much of an error rate, but even if you're wrong on a few of these, but you end up with a few compounders in the mix over a long period of time, or a die-hard cannibal which has a very stable business, the results are very non-linear. So I operated in a very linear fashion for the last 2 decades. And what I learned this year is two or three things. One is I said one thing I learned is, hey Mohnish, we're back to that curve going up. The flat curve period is over. Okay, and the second is that you can look at the Berkshire examples or the Nick Sleep examples or a number of other examples. You can look at Chuck Akre. You can look at a number of investors, and you'll see that if they've held these compounders for long periods of time, uh, the results are really good. I mean, it works out well. It would not have worked out well from 2000 to 2015, 2016. I think what I was doing worked a lot better in that period, because if you're buying these compounders at 50 times earnings, not very many good things are going to happen to you, probably. So valuation and price matters, and it was hard to find a lot of compounders in 2000. You could have bought Berkshire, for example. You'd run fairly well for for at least 10 years. But for the most part, it was what worked in that period was this buy and sell, which is tax inefficient, uh, but but it definitely was better than holding Microsoft from 2000 to 2016, for example. But so the period we're in right now, right? So what I'm assuming, even though I don't use macro or any of the things, but what I'm assuming will end up happening is what has happened in the past. And what with this party that's underway right now will end when we get to extreme euphoria. And at some point we will get to extreme euphoria. So I don't know if that extreme euphoria comes in 2025 or 2030. But let's say somewhere between, my guess is somewhere between the late 2020s and maybe the early 2030s is my best guess, is when we would get to ridiculous valuations again, because the human memory doesn't go back that far. And people always say, oh, these companies are different. They don't have anything to do with the companies in the past. So there's no real correlation. But there are correlations. So as long as humans are involved in markets, we will go from extreme undervaluation to extreme overvaluation. So if you look at the period from 82 to 99, extreme undervaluation to extreme overvaluation. And then 99 to, again, 2015, 2016, extreme overvaluation to undervalued, and then you again start going. So we will not have, I don't believe we will have these boom and bust periods go away. I don't know whether they'll be 17 years long or 30 years long or 10 years long. We've seen a few examples where they go on for different periods. I mean, if you get to extreme binges, you will go for longer periods. In general, I think that's true. So I think for me, the learnings have been that is focus on the compounders. The wiring of Mohnish doesn't allow him to pay up. I'm too cheap to pay up, right? So I'm stuck in a world where I have to buy things fairly cheap. But there are, there's 50,000 stocks in the world. There are stocks from time to time which are great compounders or great cannibals, and which do get cheap periodically. So we don't need too many of them. I mean, for the most part, great compounders are well recognized by the world, and they typically trade at premium valuations like they should. But that's not always the case. And so if we can find 2 or 3 things, or even one idea a year, which is a great compounder or a great cannibal or both, and we can get it at a reasonable price and then set it and forget it. It's great. And so when I look at my portfolio today, it needs some work to get positioned where it needs to be, but it's on its way. I'm actually very happy with the way it looks. I will make a few more changes over the next few years to get it more aligned to where I want it to be as these ideas show up. But the framework is very simple, that I'm not looking for a 50-cent dollar bill. That's not what I'm looking for anymore. What I'm looking for is very long runways at very reasonable prices with a lot of stability. So with that, I think we can open up for questions, comments on this subject or whatever else you'd like to talk about.
Hi, sir. I want to ask a question. Can you talk about one example of the failure of your investment experience that gave you the deepest impression? I mean, the failure in your investment experience.
There are a lot of failures, and there's a lot of investing mistakes. I think that's just par for the course. You're not going to be able to go through an investing career without a number of things that don't work out. I mean, in general, what we are trying to do is we're trying to extrapolate deep into the future. And businesses are kind of living, breathing things, and capitalism is brutal. So there's a lot of competitive forces acting on a lot of businesses. So there's a number of reasons why things may not work out. So if I go back and look at the failures or the businesses that I've invested in that did not work out, probably the number one reason why a number of investments didn't work out was leverage. So I had a few zeros and a few near zeros because businesses were over leveraged, and they couldn't handle the leverage they had. So I've had a difficult time in financials, for example. So in the financial crisis in 2008-09, there was a company I owned called Delta Financial, which was a mortgage lender, went bankrupt, went to zero. I used to own another company called CompuCredit that didn't go to zero, but we had a significant loss there. So I would say that probably the area that stands out, and it's not just me, when I built my checklist and I looked at, what were the businesses that great investors invested in and where they didn't work out well, the number one reason for the investment not working out was leverage. And so I've become a lot more cautious, but I'm still not there in the sense that I think there are businesses in my portfolio which have leverage, and I wish they had less of it. But that's definitely a lesson that has been well received.
Question. So I'm just wondering, when you're valuing a company, what are the most important criteria or metrics you use in determining its intrinsic value?
Depends. It depends on the business. So it's, I think different industries and different companies, you have to use different yardsticks. So like, for example, I used to own a company in China called Maotai, which makes premium liquor. And it's a business I should have held on to. But in my infinite wisdom, I sold because of the 50-90 and such. But I think Maotai went up over a 4 or 5 year period about 6-7 times. That's a business where the cost of the product is, a bottle of the Maotai Baiju is maybe their cost is $3-4, and it goes for like $150. Anytime you have a business like that, you're going to do really well. And the $150 in a few years can be $300 because they've got this incredible brand, and there's a massive growth of China backdrop, and it's a status symbol to be able to serve Maotai and so on. So when you're looking at a business like that, it's going to be quite a different analysis than, for example, when I looked at another business we owned. I think in 2012 we bought Fiat Chrysler, and so there the calculus was very different. So there we had a star manager. It was a business that was doing 130 plus billion in revenue and a $5-6 billion market cap, and pretty much if they were able to just even slightly right the ship and even eke out 2-3%, 4% in profits, that stock was going to be a multi-bagger. So it just depends. Each business and each industry, I think you have to just and the key is that you have to get to the factors that matter. Like I would say that if you look at a company like NVR, and every year they are taking 100% of owner earnings and putting it into buybacks, and you continue to own the stock, those owner earnings are not coming to you. Okay, you're owning a bigger and bigger portion of the pie, but you're not seeing any cash come to you, right? And so in that case, the thing that matters, all that matters when you own a business like that, is at whatever endpoint you want to look at. The question is, what are the shares outstanding at that endpoint, and what is the stability and cash flow of the business at that point? Because that's how the market would value it, right? So it's a very different calculus from Maotai. It's a very different calculus from Fiat Chrysler. So each business that you're looking at, I think you need to look at. So the first question, even before you get to all those things, is do I understand the business? Is it within my circle of competence? Can I figure out the 2 or 3 variables that really matter? So, for example, one of the things about the NVR home building business is they don't start building a home till there's already a person who's bought it. Okay, so they don't build any speculative homes. So I go to them and say, I look at the model and say, yeah, that's great. I'll buy the home. We sign a contract. They see I have a bank loan. And that's when they start building that home. So which means that they do not put any capital in till there's a confirmed sale, right? And the second thing about NVR is NVR does not own land, which is the biggest investment for a lot of builders. They have options on land. So they basically believe in just-in-time manufacturing, where they're saying all the factors of production that I need to build this home, I want to be bringing those together as close to the sale point as possible. So when you look at a business like that, what that means is that if the business ebbs and flows, which is the number of homes they build goes up and down with the economy and so on, it doesn't really matter as long as their core overheads are low. Okay, so let's say, for example, their corporate overhead, whatever, if they build 0 homes in a year, is $25 million, for example, right? So if they didn't build any homes, they would lose 25 million, for example. And if you can see that the balance sheet can handle that for several years, then you're fine. Then you know that if they build more than 1,000 homes, they'll make money, or more than 500 homes, they'll make money. You figure out the metric at what point they break even. And maybe they're building 5,000 homes a year, and the number of homes they build typically fluctuates between 2,000, 5,000. I'm just pulling these numbers out, and I'm not. NVR is a train, according to me, that left the station. But who knows? Maybe in the next 20 years they'll prove me wrong, where they'll buy back another 9% of their stock and be 1% shares outstanding. Anyway, what I'm trying to say is that each business is completely different, and so the key is, can you understand the 2 or 3 variables that are going to drive the outcome? And it's very important that you've honed in on those key variables. And usually the entrepreneur or the CEO running the businesses needs to be honed in on the same variables. So if you have gotten to the point where you can see the business and visualize it the way the CEO does, then it's typically that you've got the right variables.
So much for being here. In Dondo Investor, you advise the reader to look for low risk, high uncertainty businesses. And I thought that was a fascinating construct. But also last year in this class, I watched the recording and you mentioned that you hate retail. I'd be curious if you could go a little bit more into that analysis and kind of how you see the retail landscape, let's say over the next decade or two. And then maybe if you could tie that in with your observation about this period that you see going until perhaps the late 2020s, early 2030s, but specifically, how that low risk, high uncertainty formulation links to how you see retail right now.
I hate retail and Arvind loves retail. So if you ever want the other point of view on why retail is awesome, you should talk to Arvind. I've never liked retail. And one of the things about investing is, this morning I was on a bike ride with another money manager. He was saying to me that he really doesn't get these restaurants. Like he doesn't get Burger King, he doesn't get, Domino's and so on. And I try to explain some of those businesses to him, makes the bike ride go quickly. But I also told him, I said, you can have a very, very happy life, never, ever understanding what makes these, his complaint to me was that he can understand Starbucks really well. Okay. And he understands that the substitution options on Starbucks for most humans is pretty limited. Like if you get to a routine, nowadays we don't go to work or whatever, we get to a routine, you're not going to be switching your coffee every day to a different place or whatever, right? You get to a routine. But you may change the place you have lunch every day. Okay. So the recurrence of Starbucks and the recurrence of Chipotle are not the same. So that's, I'm just telling you so his perspective was that if I look at Wendy's, there's so many options besides Wendy's when you go to eat, right? And so I told him, listen, whether that framework is correct or wrong in terms of taking a pass on Wendy's, it doesn't matter. All that matters is what you do invest in. So if you unfairly get rid of Wendy's, because it might be a good business because they have 90+% franchise and all that stuff, and they just introduced breakfast and so on, no issues. So we are in a business of no call strikes, okay? So you can take entire industries and say, I'm not interested. And no, there's no penalty. So I have taken this entire industry of retail and in one big lump just dumped it on the side. And we have Arvind on the other hand, who's pouring through each one, okay? And I don't even want to pour through each one. I want to take the whole chunk and just get rid of it as quickly as possible. In fact, even now, I don't understand Amazon's retail business. I don't understand it because I say that the last mile is so expensive. Like if I order like a $7 item, they deliver it to my doorstep, the cost of that has to be like $10, $15 just to get it to my door. I mean, all the things you have to go through. But somehow Amazon makes money, and it probably works because not everything I order will be $7 and so on. And so statistically it probably works out. But the thing is that I don't get it, right? And so if I don't get it, it doesn't matter. Just let it go. So retail, the problem with retail, traditional retail, brick and mortar retail is it's the most transparent of businesses. And Sam Walton took advantage of that. So Sam Walton spent an incredible amount of time in his competitors' stores. And he would constantly, he would go to any town, any place he was going, he'd always take his team into, and it didn't even need to be the big guys. He would go to little stores, big stores. He was going all over the world, right? So one time in Brazil, there's a supermarket and some old guys flat on the ground. They call the paramedics, okay? And then they find out it's Sam Walton, and he wanted to measure the space between aisles, and he didn't have a tape measure. So he said, I'll use my body because I know how tall I am. And so, but what I'm saying, he was fanatical about the inches between the aisles, okay? So every minor thing. And so the problem in retail is that there are no trade secrets, okay? Every single thing that you're doing, your competitors can just walk in and get everything. The second problem is, so if I look at a business like, let's say a business like ADP, payroll processing, how frequently do businesses change their payroll processor? Let me just tell you, I hate ADP. I use ADP. I hate them. Why do I hate them? I look at all the costs I'm paying and I'm saying this is ridiculous. It's a bunch of digital stuff they're doing. And why do they charge me so much? So every few years I look to get out of ADP, okay? And then I figure out that, yeah, I can do it middle of the year and whatever, they'll give 2 W-2s and all that. But really for the employees, what is seamless is to do it just once at the end of the year, right? So it's simpler. So your switching is limited to like one day, okay? And then the other guy I talked to, paychecks, there's no difference. I talk to the paychecks guy and I'm not getting any special deal. Then I go to like, smaller guys. And then, so in the end, I'm back to ADP, okay? And ADP has something very important. In my opinion, one of the most important things in business is RRS. RRS, recurring revenue streams, okay? So recurring revenue streams, RRS, by the way, I made up, okay? It's an acronym I just made up, okay? So recurring revenue streams is the holy grail, what we want in a business. We want franchises which are just pounding. The reason retail is such a massive graveyard of all these companies going under is because the customer has no contract with you, okay? So I go to a Kmart, and if for whatever reason I'm not very happy with something or the other, or someone else offers something on sale, I don't have any obligation to go to them. I can go to someone else. It's totally different from ADP. I mean, ADP, they've got another business there, which is automating these auto dealerships. Every time you go to an auto dealer, they pull up and they give you your, either your sale contract or your maintenance stuff. All that is running on I think they spun off that company, but that was all based on ADP. All of these businesses that ADP had were these recurring revenue businesses. And so those businesses have another one that they spun out, Broadridge, which send out all the filings, all these companies, public companies that we send out to the investors and all that. So Broadridge gets paid X per investor, whether they send it digitally or in the mail, okay? What does it cost them to send stuff digitally? Zero, okay? Approaching zero, but they still charge, so it's a great business. So what I'm trying to say is that most retail doesn't have those attributes, okay? Now, there are retailers. So for example, when I take this whole industry and dump it, what happens is when I dump the industry, part of the dumping includes Costco, okay? And part of the dumping includes Amazon, okay? And then you look, or even Walmart, I dump all of them, right? And then I look at the stock chart on these and it looks great, you know? And so, but you know, the thing is, I just find that if I look at Walmart, I say it's a business that does well, but they need to be so good. Costco needs to be so good. Now, Costco has so much goodwill with its customers and so much that they do for their customers that moat is very solid. You know, finally, I think I understand Costco's moat, but I understand it at 40 times earnings. I did not understand it at 8 times earnings or whatever, right? So it's okay. That train has left the station. No problem. There are a million trains yet to come. So what I find is that when I look at these businesses, Home Depot and Costco and Walmart and all this stuff, they are very good businesses. But what is hidden beneath the surface is these businesses require incredible execution, and they have to every day win back the loyalty of their customers. Because you know there's constant erosion taking place from new entrants, right? I mean, Amazon comes in, and no matter how well Walmart executes, it's a paradigm shift, and it's difficult. So Walmart has to kind of change the way it is. So I think retail is I find very hard, and so in general I'm not interested. And actually, you know, one of the things is if you look at someone like Buffett and look at someone like Berkshire Hathaway has made lots of retail investments. Okay, they bought many jewelers, and they bought many furniture guys. Okay, now if you look at Warren's track record when he invests in financials or when he invests in banks or anything like that, he's batting 1,000. It's a flawless record. I've never seen him lose money investing in a bank. He's really good at it. But in retail, Berkshire, I mean, they don't talk about it because he doesn't want to, you know, have the managers lose all motivation. But it's a graveyard. Basically, I think every furniture operation they bought, other than Nebraska Furniture Mart, did not work. Every jewelry operation they bought, other than Borsheim's, did not work, and on and on. So they made a lot of forays into retail, and by and large, they didn't work. Now, it didn't matter to Berkshire because by and large, they've been small relative to the size of Berkshire, and they carry a lot of those businesses, and it's okay. But it didn't work so well.
To clarify, Monish's reference to my retail love is really a Costco love. So I don't want to...
Oh, no, I think, Arvind, it goes beyond Costco. Costco is like a torrid affair. Okay? Costco is not just an affair. Costco is like gone off the charts, but the others are still there.
Costco is more like...
There's still some love with the others.
Costco is more like my wife. There's just my wife, and
Make sure she can't hear that. I don't know whether Nina would appreciate that. Being equated to Costco.
I think she may love Costco
more than you?
with me.
All right.
Not more than me, but Sid, I saw you raised your hand as well.
Mohnish, thank you for being here. As a South Asian immigrant, obviously, I enjoyed the Dando Investor, so thanks again. I was curious, you mentioned earlier in your remarks, 50,000 stocks. You clearly have breadth across geography and industries and business models. Where do you start? Sort of what is top of funnel for you, especially since it seems like with the 50 cent and exit at 90 cent strategy, you have far more velocity in sort of your portfolio than many other value investors I've sort of read about and spoken with.
Well, hopefully that velocity is going to zero soon. That's where we want to get to. So when Buffett is asked that question, he says, start with the A's. Okay, but I'll try to give you a better answer than Warren. There are some hacks. So 50,000 stocks is a lot. And actually, when Warren says start with the A's, he's not kidding, because he went through the Moody's manual, every page. And, the Moody's manual, they stopped publishing that several decades ago. So I bought a few of those on eBay just to get a feel for, what the Messiah used. And yeah, it's pretty dense stuff. I mean, got like 4 or 5 businesses per page, very small fine print, and he went through all that. Lilu's done the same thing. So definitely, you can put your nose to the grindstone, and you can start pounding through these businesses. I tried to get Warren interested in Capital IQ. I said, Warren, you. One time I was in his office and he was going through the Japan company handbook, and I said, Warren, if we get you to splurge on Capital IQ, you can run screens and this and that. And I even got to showing one of his assistants kind of, how to do all that and everything. And he's not going to spend that money. He wants his $50 book, and that's all he wants. So anyway, and it's worked just fine for him. But you can hack this a little bit. So one way I hack it is you can look at what other great investors have bought. Okay, so you can make a list of investors, and it's interesting to actually categorize them. So if you look at someone like Chuck Akre, you'll see a certain pattern to what he buys. You look at David Tepper, you see some different patterns, or you look at Jeff Urban and so on. So you can find different patterns with the different investors, and Data Roma does a good job of giving you a whole bunch of investors and what they own and such pretty easily. The price is right; it's zero. So that can take that 50,000 share, the 50,000 stocks down by more than 90%, maybe even 98%. Okay, and then the second hack you can do is the first question I ask myself when I look at a business is it within circle of competence? So you can winnow that list down different ways. You could run screens for low Ps or whatever, but I think that looking at what other great investors own is a good filter. Because already gone through one filter, especially if they're larger holdings. Then the second question you ask yourself is it within circle of competence? And that'll take out quite a few businesses as well. So, and then, if you're like me, anything retail, gone. Anything financial's gone, right? You just have these, anything pharma, gone, healthcare, gone, all of that. So I can take out a lot of stuff relatively quickly. And it doesn't matter if I'm doing this mass stuff and there's good stuff going away. There's no penalty for that. There's infinite amount of good stuff. So you can keep throwing away a lot of stuff. And then you get down to some things that, strike your fancy or you get interested in, and then you go deep.
Feel free to jump in. I saw Vishal, Rusty, Sam all had questions.
Sorry to take us back a couple questions, but to kind of piggyback off what Frank had mentioned as far as valuations, a lot of your investments are emerging markets overseas where accounting standards aren't exactly a thing. Management may be a little bit more difficult to get in touch with. So what sort of extra legwork do you have to go through in order to make your investments and arrive at an investment decision?
I think most of the international stuff, I think I've usually had to go see the business and kick the tires and assess the management and so on. So it's definitely involved more work, but it's a lot of fun work. Actually, I enjoy that. So yeah, you do have a few more layers to peel as you go from. I mean, one of the things I don't have to worry too much about is that I think the odds that I would lose money in the US on an investment because of fraud approach zero. They make the headlines here and there, the Enrons and stuff, but the odds that something like that enters your portfolio is very low, especially if you're then doing research and work on it and you understand the business. I think something like Enron would be just beyond my understanding, so a pretty easy pass. If I can understand Amazon, Enron is very far from that. So basically, I think you have a little more work to do, but you also have more rewards in the sense that sometimes the tailwinds can be a lot stronger. And I think that I think in general, entrepreneurs around the world, most of them are trying to make a go at it fairly honestly. I think that's a general trait across, and yeah, you do have to kind of check that box and test it a little carefully, but you can get there, not a problem.
I can go. Mohnish, thank you so much for doing this. This is so much fun so far. I have two quick questions for you. You mentioned earlier that you've learned a lot during this pandemic. I was just curious to learn more about like how you managed your portfolio during the pandemic or are managing your portfolio, and what have you learned so far. And my second question is, so we had someone from Fidelity last week, and the portfolio manager told us that a lot of people currently are investing in growth. I'm just wondering if value investing is dead, or is it that, do you still believe that value investing has a place today? Thank you.
Yeah, I think regarding the pandemic, so couple of things. I mean, I think in the March timeframe, when this data was kind of coming out about, kind of how big this was going to be and the shutdowns were starting and so on, I was trying to understand kind of, what kind of impacts it would have on the existing portfolio. So the thing is that capitalism is very brutal. And in the best of times, most businesses are very fragile. So most businesses cannot withstand the kind of shock of these shutdowns and stuff. Most businesses cannot handle that. It's really hard. And so, for example, but I think when I looked at my portfolio, like for example, I own some real estate companies in India. So these businesses, they don't have much leverage. Their sales velocity was going to go down, but I didn't have any concern about stability of the business. I said, yeah, they'll have less sales, and they've got some, like I explained to NVR, they've got some corporate overhead, and can they handle that? I said, yeah, it's not a problem for them to handle the overhead. So I was not concerned about those businesses. I got quite concerned about one of our companies, Fiat Chrysler, because the car business is so much operating leverage, and when you shut down a car plant, I mean, you've taken that whole thing in reverse. So I actually could not see. I was very concerned about how this is going to affect them, how long it's going to last, etc. And so we completely exited the position. And I exited at a significant discount to where it was trading before the pandemic. And even now, I mean, it's come back in a manner that was different from the way I expected. So if I had done nothing, I would have been better off, but I couldn't see it. The uncertainty levels are way too high. And I had seen that business have trouble in the past. So we didn't take a lot of actions in the portfolio. We took some actions. But on the flip side, what also happened at that time was there were great opportunities. So especially in March, towards the end of March, when the markets were tanking, we were able to put money to work. And so I made 2 investments, and they've done very well. So and I'm very happy that we made those. So the pandemic, I think, is now, I think it's a little bit more, there's more clarity about it, and it's still going to last for quite a while. I think that it'll take a while because we need to get to the point where, in effect, people have some kind of certificate or passport or something which says I'm vaccinated and whatever and such, and for business to come back and business people to have meetings, everyone needs to have that sort of thing in place. So that'll take a while. And so I think, but we are already finding in California, for example, the freeways are getting clogged up, and so things are coming back. The have-nots. I mean, this is really stressed the have-nots, and it's really unfortunately widened the gap between the haves and have-nots. It's a very sad thing in terms of what's happened with the pandemic, in terms of who it's impacted. Growth and value are joined at the hip. There's no difference. All intelligent investing is value investing. So if a company is growing, all that means is that you've got more coupons in the future, and they've got higher coupons, and then you discount them to whatever rate. So it doesn't matter whether those coupons are growing at 20% a year, or they're growing at 0% a year, or they're declining 5% a year. All 3 cases will give you a valuation on which you can invest. You're better off having high return on equity and high growth. In general, that's really what's going to, and long runways with that. But I don't particularly see it as one is different from the other. I think if I have a choice, I want to invest in growth. And anyway, I told you that the 50 to 90 cents is not of as much interest. I want to get to the long runways and such. So, but I want to get to the long runways without paying up too much. So,
thank you for joining us today. My question for you relates to one of the points that you made in your book that when I read it a couple of years ago, I thought was really brilliant, which is that embedded options tend to be mispriced. Since I read that, it's something I've been on the lookout for a few years now. And one of the things that I've observed is that actually these things tend to be understood, at least in the businesses that I've looked at. So I'm wondering whether you think that's a concept that now tends to be more widely understood by the markets, or whether you still find options that are in fact mispriced.
You're talking of the optionality in a business, right?
Exactly.
I mean, I think that persists always. I mean, markets don't like these kind of wide outcome ranges. I think what markets are really good at is they want to see a cookie cutter, and they want to be able to see what that cookie cutter can do over a long period of time, and they want a straight line. Right. So if I have a business like Costco, that gets as much as like a cookie cutter as you can imagine, right? They have a pretty well-defined model. They do innovate within that model, but they know the path they're going down. I would say optionality on Costco would be like, they're in such a small number of countries. They could expand that quite dramatically. China just started for them. And so on, but it's also richly priced. So I think that I find that what markets don't appreciate, because most market participants did not run businesses or have not run businesses, is they don't appreciate the messiness of the real world. and they don't like the messiness of the real world. And so that actually gives an advantage to an investor who appreciates that. So the reality we know in businesses is that things don't go in a straight line, and that you're going to have ups and downs, and that businesses will open up brand new things that you never imagined, were not part of the model. Like Starbucks starts reserve, right? So they're going to go higher end on the coffee, or even starts serving alcohol, for example. So if those kind of tangents work, it changes the paradigm. But the market's not willing to recognize those typically because they see a lot of uncertainty with those. So yes, if you can figure out optionality of the business, and you can handicap the probabilities of the optionality, or you're not paying for it at all. You're paying for the core business, you're not paying for the optionality. Then those can be really good. Absolutely. Like one of the things I didn't appreciate, but it came out later, was that like when we bought Fiat Chrysler, for example, in 2012, I was just looking at this as a car business with a great CEO who was going to right the ship. And if he righted the ship, they would make a few $1 billion a year, and the market cap would go to 4 or 5 times what it was. What I did not appreciate about Fiat Chrysler was that I knew that, for example, Ferrari was embedded inside the company. But at that time, when I made the investment, Ferrari was making less than 150 million a year. And I said, okay, you can give this a 15 multiple or something. And, it's got maybe a couple of billion of value or something, but it's not going to, what I was looking at is that, can this 5-6 billion get to 30 billion, for example, right? And I could see that the core business could get to that, right? But I just dismissed Ferrari. And as it turned out, I mean, that Ferrari portion that we in effect paid, when I bought the thing, we paid about $16 a share for Ferrari inside Fiat Chrysler, and it went to 200, 190 or 200, right? And so it was 1/3, eventually got 1/3 of the value. So it did way better than the rest of the other pieces. And then they had a parts business. They had several parts businesses which they got rid of and spun out and so on. So there was a lot of stuff that came out of Fiat Chrysler, which was not part of my original analysis. And I just said, okay, we've got a gifted manager, and he's going to make sure that we get good value from these pieces. So the optionality there was not even something I was focused on, but then after a few years, I realized there's a lot of different pieces here that I haven't accounted for, and that worked out very good.
So I was wondering, you've talked about long runways, and I was just wondering, how do you find long runways, and where do you see long runways?
Expert on long runways is Arvind. That's what you need to do. You need to put your arms around Arvind and ask him.
It's hard to do that in a COVID world.
He's a Mr. Long Runway guy. His full name is Arvind Long Runway Navaratnam. It's a middle name. I mean, I think that it's a really good question, and I think the best way I can answer that is that if you make 10 bets on, carefully selected, all with long runways, at least your perception that they have long runways. So one of the problems with long runways is that, I already told you, capitalism is very brutal. I mean, there's all these forces coming from left field and center and everywhere else trying to chip away at any competitive advantage, right? So people look at ADP, and they look at that incredible moat, and they want to constantly hammer against that moat. Or people look at Visa and MasterCard and look at that moat, and they want to keep going against that moat. And many times they will succeed. They will succeed at collapsing that moat. That's the nature of, I mean, if you look at, dominant businesses 50 years ago, 100 years ago, even 30 years ago, how many of those are dominant today? I mean, most have gone by the wayside because capitalism is really hard. But if you make 8 or 10 bets, and you're careful on the valuation and what you're willing to pay, and you are convinced that the moats are quite resilient, even if you're wrong 40% of the time, you will still end up very wealthy. So you're not going to bat 100% on the long runway game. I mean, look at Warren and Charlie. All they're doing is trying to buy long runways. But if you looked at every acquisition Berkshire has made, and you equal weight every acquisition, I would say easily a third have not worked. Right now, if you dollar weight it, probably 80-90% have worked. But if you equal weight it, a lot of the decisions didn't work. And these are the gods of investing, right? So we're going to have mistakes. We're going to have things that we think are going to work and they won't work. But bottom line is that if you make 10 bets and each one is 10% and one of them becomes a 30 bagger, and 3 or 4 go by the wayside, and some of them are 5 or 10 baggers over a 20-30 year period, you'll do just fine.
So I have a question kind of on that topic about moats. When you're assessing moats, is it more conceptually, or do you do it more analytically? And how confident in a moat do you have to be to ultimately invest in that company?
It should be very obvious to you. I think you should be able to look at it, and you should have very high degree. So, I mean, let's say we look at a business like Starbucks, right? So, I mean, if you were investing in Starbucks, the big question is that, what does this company look like 20 years from now or 10 years from now? Is the moat intact? Are people still going in? Who are their competitors at that point? I mean, these are the questions you need to answer. How big the runway is, how far they can go, what can happen. And there's a range of outcomes, but you need to be convinced probabilistically that most of that is skewed towards a great answer. And if you look at a business like Chipotle, for example, a lot of people will look at Chipotle and say, what's the difference between Chipotle and some, taco stand somewhere? And I think there's a difference. I think there's a big difference between almost all Mexican restaurants and Chipotle. And in my opinion, they've widened and deepened the moat. I mean, in their app is great. They've, in the pandemic, done a really good job with keeping the business profitable with deliveries and, all of that. I mean, the dining rooms are shut down, but they've been able to survive all that. And the infinite customization you can do on it. So there's a number of things there. But again, the question would be, when you look out 10 years, 15 years, what does that business look like? Does it become Chipotle's all over Europe, all over Asia, all over Latin America? Does that happen? What are the probabilities of that happening? Who else enters the space? Will they keep executing? What will be their ROEs in the future? I mean, there's a whole bunch of things that come up. So I think what I'm saying is that you've got to start out with admiring the business and the moat. Like, you've got to intrinsically know that, like, even before I look at any ADP numbers, I know it's a great business. Okay, even before I look at any Visa numbers, I know it's a great business, right? So first thing is you've got to mentally have a kind of framework in your head that tells you, yes, I like this business and I think it's great. I think that businesses like Chipotle are harder because they don't have recurring revenue and all these things. I think some businesses like ADP may have more resilience because even if there's a disruptor, businesses are not going to be wanting to change payroll quickly because it's such a small portion of their costs. Like, I mean, for me, messing around with payroll makes no economic sense. Okay, it just irritates me, so I go down these irrational paths. But basically, for most businesses, it's not worth the time of day. It's payroll is running fine, leave it alone, right? And so those businesses have a much higher degree of resilience, in my opinion, than a Chipotle, right? Because there you got to keep earning the customers' confidence and trust every day, and so on. So I think moats come in so many widely different shapes and sizes, and all kinds of things happen. Boeing, what an incredible moat, and then all hell breaks loose. So I mean, if you looked at Boeing 3 or 4 years ago, you would say this is unbelievable. They've got this huge pipeline. They don't produce a white tail. I mean, just like NVR doesn't produce a home that's not already sold, Boeing doesn't produce an airplane that isn't already sold, right? So there's no white tails, and they've got a big order book, and they're a duopoly, and and they've got a great defense business and all that. It's an incredible business. But look where we are, so such is life.
So thanks for being here too. It's really great to have you here. My question is more on the selling side. You talked earlier about the 50 to 90%. You sell at 90% intrinsic value. Now we're talking about long runways, but you keep on looking for new business opportunities, I'm sure, as well. At what point do you say, you know what? I thought this was a good business. I think it has good growth opportunities, but I got this business here that I'm looking at, and it looks like it's more valuable. How do you go about this part? It's probably selling off. I don't know how you do it, but do you sell good positions for what you think might be even better? You have any?
Yeah, it's all opportunity cost. I think those are why you get paid the big bucks. I think you have to continuously do that. But it's a difficult exercise because the mistress always looks hotter than the wife, and actually the wife may be hotter, but you think the mistress is hotter, so you got to make sure that the mistress is actually hotter, not just that you think it's that way. So anything that we know really well, we also know all the blemishes really well, right? And this new shiny thing on the side, we don't know all the blemishes yet. So that's one of the things, is that the greater your familiarity with the business, the greater your familiarity is going to be with all the, Arvind's probably really, really familiar with all the negative issues with Costco. Okay, he knows those really well. I can't believe Costco has anything negative, but whatever negative there is, Arvind's aware of. But
long lines.
I'm sorry, what?
Long lines.
Oh yeah, long lines. Yeah. Like every time I pass a Costco gas station, I think I'm in some socialist country. I think I'm in Russia 30 years ago or something. I'm saying, why in a capitalist society do we have these long lines for gas? But that's the way it is. Such is life. So I think you have to be careful that you don't fall into the mistress trap. And as long as you are genuinely looking at something that is better than what you own, better value than what you own, and you consider the tax implications and all of that. I have a good friend, Guy Spear, and another friend of mine, the way he describes Guy is, he says he has the highest return of any investor on the planet based on effort expended. okay, on a every hour of effort expended, Guy is off the charts. Okay, so the thing with Guy is that anytime, and I bounce a lot of ideas off him, anytime I bring up any new idea to him, it doesn't matter how good it is. He is not changing anything. So I tell him, Guy, listen, you've got Nestle, okay? Nestle is done, okay? 30, 40 times earnings, whatever, done, okay? We've got this thing at 3 times earnings, which has got this massive runway. Can we please sell Nestle? Please. And I get nowhere. He's not willing to make any changes, okay? And then after I keep badgering him over and over and over, he'll buy 2%, okay? And that's it, you know? And I mean, he loves long runways, okay? He loves deep moats. He loves all these things. So I told him about Mautai, okay? I mean, great brand, blah, blah, blah. All that. I said, this is it, Guy. I know you don't like all the shit I bring to you, but this is like a real runway. He said, I'm not buying any Chinese company. I'm not going. I said, it's fine. There's no issues there. 50% payout, all this stuff, good governance, blah, blah, blah. Okay. I'm not going there. Okay. And then I kept badgering him. And I think he put like $100,000 into it just to get me off his back. And then after a few years, we went to China together and we visited Mautai headquarters. And then he says, and you know, by that time, it's now gone up about 5 times. And then the whole trip was, oh, I missed this. Oh, I should have bought this. I said, do you remember? Do you remember all the calls I made? And I was pounding, and I couldn't get through. Oh yeah, I don't know what was happening. This is such a no-brainer. This is so easy, blah, 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 you know. So, but you know, actually inaction is what saves Guy. So the best thing that you can do is don't make switches if it's 60-40. Don't make switches if it's, you know, this is a little bit better and I'll make the switch. No, make the switch hurdle really high. Like the mistress has to be really, really hot. Okay, not just better than the wife. Okay, they're all better than the wife, but really hot. And then you're fine.
Question about competitive advantages. So you have a rule of only investing in copycats as opposed to innovators. So my question is, do you believe that there's a first mover advantage?
That's a really good question. So I think that one of the mental models which has served me really well, and it's a weird nuance of humans. And I still don't understand why humans are this way, but they are this way. Humans are bad at cloning and copying. Most humans and most companies almost think that it's beneath them. They somehow think it's kind of, you know, so what that does is it opens up a significant window of opportunities that would not exist without it. So obviously, if we are right on the innovators and the innovators, you know, grow and scale and whatever, we do really well. I mean, you know, but if we look at a company like Microsoft, for example, Microsoft is the ultimate cloner. Okay. After they came up with the basic compiler in 1976 in New Mexico, everything has been copied or stolen from then on. And they're not even very good at cloning. Like, you know, when they tried to clone the Mac, it took them like 15 years and 10 versions to get there, you know. And so Excel was copied from Lotus, and Word was copied from WordPerfect. PowerPoint was acquired. Access copied Oracle and Sybase, and they finally gave up on search and they kind of went with Google. But the acronym for Bing is, but it's not Google. So they not only they're not a good cloner, they many times they fail. Like forever they tried to clone Quicken, and they came out with money, and they were never able to get traction there. They put a lot of effort into search, they could never get traction there. So even with being a bad cloner, like for example now, Microsoft has Teams, right? And Teams copied Slate, right? And they will probably kill Slate because they're so good at eventually getting these things working, and then eventually the incumbent has a problem. If you look at someone like Walmart, for more than 10 or 15 years after Sam Walton founded Walmart, for at least the first 15 years, there was no innovation. Every single thing about Walmart was copied from Kmart and Sears. They just lifted that model. And the reason why Sam Walton spent all this time in all the competitor stores is because he had no ideas of his own. He just looked at what other people are doing, and he copied the best of what he could find. And that's what, so if you look at Walmart, I mean, what is the intellectual property of Walmart? Now, after 15, 20 years, they got, a bunch of competitive advantage with scale and logistics and all of that. But in the first 10 or 15 years, there's no advantage. All they're doing is it's execution. It's great execution on a base model. If you look at Costco, everything about Costco was copied from Price Club. So Sol Price. So if we talk to Jim Sinegal, someone asked Jim Sinegal, what did you learn from Sol Price? He said, it's the wrong question. There's nothing I know that I didn't learn from Sol Price. Okay, so the whole Costco model, everything about it, and actually the cloner became better than the original. Like Walmart became better than Kmart, and Microsoft became better than so many other companies. So I think that, yes, you can invest in the innovators, but I think that's much harder to get right. If some businesses are consistent cloners and they're good at it, and I don't think markets recognize the power of great cloning. So if you can identify, I think even at some level, if you look at someone like Starbucks, he looked at what was happening in Italy and he said, I think this will play in Peoria. And he took that Italian cafe and brought it to Peoria. And the funny thing is now Starbucks is scaling in Italy. Who would have thought that they can scale in Italy, but they're scaling in Italy. So I always feel that if you can identify a business that is good at cloning and has kind of embraced it the way NVR embraced the buybacks, that's a great mental model and advantage to have in your arsenal.
Coming on, really appreciate it. I was curious if you could talk a little bit about how you document your investing process. Earlier you mentioned a bit of a checklist, and you mentioned a little bit about focusing and really honing in on those 2 or 3 variables that you really have to understand. So maybe just talk about that checklist. Do you write things down? Do you do Excel models, or what gets put to paper, and what's the output along the way from idea to purchase?
For most of my career, I functioned alone, and now because I had another entity and I've got horsepower, so I've got 2 guys who help me and work with me. I have not, I think almost never built Excel models or anything like that. They will do that sometimes and such, but the precision can be can lead you astray because businesses are not, they're not linear and they don't grow 15% a year every year and so on. So I think that model in your head where you're able to figure out kind of what is going on and how this business works and how it makes money, and then you go deeper and see if all the facts check out. The checklist comes in before the investment, and the main benefit the checklist has is that we are driven by greed. So when we encounter some new shiny new investment ideas, we can be enamored by it, and the checklist kind of puts a lot of cold water and a lot of stuff. So it asks a bunch of questions that the big advantage it has is that many times I've not even thought about those questions. So I think I've thought about every side of it, but when I actually go through the individual questions, like I think our checklist has about 160 questions on it, and I'll find that I don't know the answers to 10 questions, and which means that I have more work to do. And so that's the big advantage, is like it identifies holes in the analysis, and then I go back and do the work to be able to answer those 10 questions. So that's where the checklist comes in. It's really just trying to make sure you've thought about things in a complete manner. And also what it also shows you is there are no businesses, maybe other than Costco, that go through a checklist with no blemishes, like everything is fine. Every business has issues, and those issues will get highlighted by the checklist. And the question you got to decide is this issue going to be the one that does them in, right? And so you got to make a judgment call on that. So there are, I think that it's part art, part science. So you can look at the areas where the business has vulnerabilities and issues, and then you got to just see, hey, can I, does it still make sense when I know these are the areas where the business may have difficulty? Does it still make sense?
Hi, sir. Thank you for your time. I saw a speech of you, and you mentioned that you invested in one steel company that is undervalued, and you made over 100% return in just half and 1 year. I wonder, what tools do you use to find out a company that is undervalued? You read the balance sheet, or you have other tools?
So we made a 4x on that company in a couple of years. That was a company called IPSCO. It was a Canadian steel company, and there I think it was a relatively simple thesis where the stock was in the low 40s and they had no debt. They had about $15 a share in cash, and the next 2 years of contracts that they had on their books was going to give them about $15 a year in earnings. And so my take was, and it's a very high uncertainty business with a lot of fluctuation in earnings, because they made tubular steel, which went into pipelines. So if a big pipeline is being built, then they have contracts, and there could be no contracts after a couple of years, right? So the situation was, I'm paying $45 a share, and I fast forward 2 years, I have $45 on the balance sheet, and all the plants and equipment and inventory is free. So I said that doesn't make sense. The business has to have a value over $45, because all those things can be liquidated for some price if you're not a going concern. And if you're a going concern, it has even more value than a liquidation scenario. So I said, what I'm going to do is I'm just going to buy this company and own it for 2 years. and just see what the market does to the price. Because I said, let the $30 come in and let's see what the market does. And I think about 8 or 10 months after I bought it, the company said that they have one more year of $15 a share in earnings. And so I said, oh, so now we are at $60, right? Because we got 3 years of $15. And the stock went to, by that time, it had gone to $70, $80 a share at that time. And then it was inching up to maybe about $90. And then a Swedish company came and offered to buy them for $160 a share in 2006. And I didn't even wait for the deal to close. The stock went to like 150 something. And 5 minutes after that, I was out of there. So that was fine. And so if you look at Value Investors Club and you read write-ups there, that's a good place to understand and find businesses. If you have a subscription to SumZero or you're a member of SumZero, that's another area where you can get some of this. And then sometimes there are articles on Seeking Alpha and so on. So there's a few different places. And then you can look at Data Roma, and then you can try to reverse engineer, why does David Tepper own this, or why does Ackman own something, and so on. So you can try to reverse engineer some of those and take it from there. The different things happen. Like last year I visited a company in Turkey, in Istanbul, and they have a few different businesses, but they have a bunch of warehouses. They have like 12 million square feet of warehouses, and they're the largest warehouse operator in Turkey, and their tenants are all like IKEA, Carrefour, Amazon, and so on. I mean, they've got really, really blue chip tenants. And the market cap of the company was like less than $30 million. And the liquidation value was somewhere between maybe $300-400 million to $1 billion. Okay. And once I had, kicked the tires enough to know that all those things were real, and, we spent an afternoon going to all the warehouses and so on. We loaded up, even better than IPSCO, right? If I can buy a asset for 30 million that on a bad day is worth 300 million, Turkey has a lot of challenges, but in many cases, micro will trump macro. And at some price, your risk levels go down. That business has gone up about 7-8 times in value in the last 13-14 months, in spite of the pandemic and all that. So anyway, so what I'm saying is that you keep poking around, and once in a while, things hit you in the head like a 2x4. And when they hit you in the head by 2, they say, what? What was that? Like, when you're like really like shocked and surprised, that's when you act. It was like, if you're just saying, oh yeah, okay, whatever, just ignore all of those. Look at the ones that totally blow you away, and then go for those. Shock and awe.
In your book a lot about the Kelly criterion, but you kind of say you never go full Kelly or anything like that. So how much of a role does it play in your capital asset allocation decisions? Is it more of like a guideline, and do you hard and fast, like do the math out kind of thing? And then the follow-up would be like, do you apply it to your entire portfolio or just your dry powder?
If I ever do a revision to the Dhandho investor, I will take out the Kelly discussion entirely. And in fact, I will even say that it doesn't apply to investing. So I don't use the Kelly, and it was a mistake to put it in the book. The main issue with the Kelly criteria is that it works really well if we get to make a bunch of similar bets. Like if you do 100 coin tosses, where heads is 51% and tails is 49%, and I keep betting heads, you can use that formula to figure out if you have $100, how much you should put on each bet. So it's good for when you get an opportunity to make many bets which are very similar in odds. But it doesn't apply like when I talked about the company in Turkey or the steel company, whatever else. I mean, those are investing, we're making one bet at a time. And we don't have the luxury of making a second or third bet like that. So I would just ignore Kelly completely. I know it sounds exciting and everything, but it's not relevant.
So how do you manage the balance between, say, diversification, and then also you talked a lot about staying within your circle of competence. So how do you like manage those things without like throwing away everything?
You can throw away nearly everything, and that's fine. So Arvind heard me talk many times about Charlie's friend John Arriaga in Northern California, who's a billionaire, and all he's done in his career is invest in real estate within a couple of miles of the Stanford campus. So John Arriaga's circle of competence is like this small. It's really tiny. It's not even real estate. It's not even real estate in California. It's not even real estate in Northern California. It's real estate in a very narrow geography. If you showed him a deal in Sacramento, it would take him a femtosecond to say, I'm not interested, because he doesn't want to go there. So, and with being in a very, very narrow circle of competence, it did not prevent him from becoming extremely wealthy. So the good thing about investing is that it doesn't matter how big your circle of competence is. What is really important is to not step out of it. And what is even more important is just try to play in the epicenter of that circle. So if you look at a business and you say, I'm not sure about this, or I don't understand this, or whatever, be a harsh grader and get rid of it. And focus on the most obvious stuff. And some of the most obvious stuff is things that we are consumers of. So if you're using a certain brand, or you're using some service or whatever else, I like to bike, and a lot of the biking parts come from a company called Shimano in Japan. And I know from biking that Shimano has very strong brand recognition, and they've got pricing power and all these things. I've never looked at the balance sheet. I just know this from the way they dominate in cycling. And then when I looked at them, I also found they dominated in fishing. And that even in the fishing area they've innovated a lot in that area. So I looked at Shimano, and it didn't look obviously cheap. Like I was hoping that no one else would understand Shimano, and it would be at 2 times earnings, and the rest would be history. But it wasn't that easy. So I said, it's like a double-digit earnings, whatever, forget about it. Move on. If it was really cheap, I would have spent more time on it. So, and I only looked at that because I was just familiar with it from cycling, right? So it can come at you from different places.
You mentioned Sergio from Fiat, and obviously Howard Schultz, Starbucks, Sam Walton, obviously all very great leaders. I'm curious, kind of what you look for, certain traits that you look for in a board or a CEO, a management team. When you're making those investments, how you kind of judge a management team, and then if there's any specific, or other specific leaders that have really stuck out in today's market.
Good question. So the way to figure out the quality of the leader is to not focus on what they're saying, but to focus on what they've done. So typically these guys have track records, and you can look back at the track record. I mean, it would have been hard to invest in Walmart in 1970 or whatever if you were unless you were really familiar with Sam, but if you're investing in 1980 or 1990, you've got quite a track record to look at. Sergio, it was very obvious to me in 2012 what was a very unusual and good leader, and I was very excited that we were able to actually, and it actually, as that investment progressed, my assessment of him kept getting better. Like I had underestimated how good he was, and he just kept getting better and better, and such. And so I think the one thing we have as public market investors, which venture investors don't have, is we do have trademarks that we can look at, and we do have relatively long histories that you can look at. And so I think that is really helpful. And that's really important. It's really important to get a mental model in your mind about the nature of the leader and the quality of the leader, and their nuances. And you don't need to always get this right. I mean, there's an error rate. When I bought Fiat, I also bought GM. And GM, basically, we made some money. I think we made 40-50% on what we invested after several years. But eventually I sold it because I just saw differences, very big differences. So that was a good example, because I felt like GM had competent leadership, but it was nothing like Sergio. And then, if you look at someone like Elon, I mean, he's on a different planet. I mean, I don't know if you guys saw Battery Day, when he had the Battery Day and the annual meeting recently. I mean, if I was a competitor of Elon, any OEM car manufacturer, I'd be very afraid, because those guys, every other CEO has no understanding of first principles of physics. And so I think they're going to have a very, very hard time. And he's increasing the distance. So we don't know how that works out, but I would just say that, extremely impressive guy, and kind of strange, somewhat weird, So I'm in the Charlie Munger board, which is saying, don't go long or don't go short Elon. It's hard to go long Elon because it's just so expensive. But I would not want to short a guy who lands 2 rockets simultaneously backwards. I mean, I don't know why anyone would want to short a guy like that. So anyway, I mean, I think that you study the history and the trademarks.
So Mohnish, you've been so generous with your time. Thank you so much. I guess maybe I would end with one last question, which is, on this Zoom call, there are students who are graduating from business school, from college. Just that, the world has shifted dramatically. They may feel for their opportunity set. Are there any thoughts that you have, or any advice that you would give over the decades to come, and also the short term?
A couple of thoughts. So one is that in an advanced civilization like the United States, the odds that any of you will be homeless or not have enough food to eat, or can't pay your rent or any of that, those odds approach 0. So basically the bottom line is that the society has enough safety nets and has enough opportunities that none of you will ever face those circumstances. So given that reality, what I would focus on if I were you is I would focus on the pursuit of passion. So I would really try to figure out what is really exciting for you and what you really like to do. And one of the things Buffett talks about is people will say, oh, I'm going to do banking for 3 years, then I'm going to get my MBA, then I'm going to do XYZ, and then, after 10 years, I'm going to do my own thing. You don't need to take these long circuitous paths. Think about what you want to do and just go for it. Get there without making a 20-year plan to get there. And I think one of the problems that comes up when you graduate from elite institutions. So the problem you have when you graduate from Boston College or Harvard is the opportunity cost. So what happens is that the world is willing to pay quite a bit for your services. And many times the world is willing to pay more for your services than you would make if you pursued your passion. And if you pursue your passion, you are giving up a lot of certainty. But given that I told you that you're not going to end up homeless and you're not going to end up with no food on your table, I would say that stretch a bit and try to understand internally what you love to do, and then the other thing is that even if you take the easy path, which is some guy's giving you a great offer and it looks great, whatever, you still have plenty of time, evenings, weekends, etc., to try to think about what else might be your passion or interest, and to try to build something. Like my first business, I got off the ground part-time while I was working full-time, and then when it got enough traction, I resigned. And I didn't have any money or anything. I actually was on credit cards and so on to try to get it up and running. So that's what I would say is that the younger you are when you do that, it's easier. When you don't have kids and do that, it's easier. And when you're single and you do that, it's easier. So for many of you, all of those are true. And so I that's what I would suggest is if you really want to go down a certain path, I think you should really think about, we humans are driven by peers, and we like to compare ourselves to peers, and you have a lot of peers in the institutions you're at, and so it can be difficult to do something. I remember that the founder of, I think it was Staples, went to Harvard Business School, and then after that he joined some grocer. And I think while he was in school, he was working in a grocery store, kind of doing the shelves and whatever else, and he said that some Harvard professor walked into the store, saw him doing that, and didn't want to embarrass him and just kind of went the other way. And he went out and, reached out to the professor and said, how are you doing, whatever. He was not at all concerned. And so, so that guy wanted to go into retail in spite of all the things I've said. And he was passionate about it. And he turned down a lot of other offers, which were probably higher paying. And he went into that area and eventually founded Staples and went from there. So you have to be willing to get off the beaten path, and that's what I would suggest is be willing and bold to do that.
What a great note to end on, Mohnish. Thank you so much. This was fantastic as always.
Thank you, Arvind. It was a pleasure. Thank you.
Thank you.